So let's move into Chapter 5. Chapter 5 is a continuation of our discussion of mortgages, or the debt side of real estate investment. And we move from the fixed rate to the adjustable rate mortgage. And as I pointed out in discussions in Chapter 4, the main difference between adjustable rates and fixed rates is that the interest rates adjust on the mortgage at some index that is tied to the overall interest rates for other assets or investment vehicles, as well as debts for corporations, automobiles, bank loans, etc. Usually, these adjustable rate mortgages are tied to an index, something like LIBOR, or the London Interbank Offering Rate. That's the rate that banks charge to borrow money from each other. Those interest rates vary typically on an annual basis. So whatever the rate is, or the rate anniversary is, the new rate will be in place for a period of 12 months. The key difference between adjustables and fixed, as mentioned previously, is that the borrower bears the risk of rate changes, and this risk is passed from the lender. If you think about it for a minute, if lenders make home mortgage loans today, they're charging roughly 3.5% to 4.5%, which is, historically low. I understand those of you that are relatively young have seen rates this way since, for 18, 19 years, since basically the financial crisis. When I was 18, interest rates in the mortgage market were roughly 18%. Throughout the 80s and 90s, we didn't see anything that resembled a 3, 4, or 5 rate like we're seeing today. So financial institutions that make loans today are basically going to sell them to investors at a relatively low interest rate, and those investors are going to be stuck with that rate for a long period of time. What will happen, obviously, is that the value of that asset will go down as interest rates go down, much like if you were to purchase a bond from a corporation or a municipality. The coupon rate is fixed, and as rates in the market change, the value of that bond adjusts accordingly. What happens for the benefit of the borrower for accepting these rate risks? Well, they're typically charged a lower origination entry rate. Here's an example of some of those interest rates. So on the bottom here, you're looking at a graph that runs from July of 99 through January of 2018. And you can see prime rate. This is a rate for a 15-year fixed mortgage. This is a rate for a 30-year fixed, and then a 10-year treasury, if the collars aren't coming through on your computer. You can see take a quick look at the prime rate, the red line. It does a really nice job of illustrating to us the financial crisis that began, as you can see, even though most people refer to it as 2007, there was already plenty of concern and anxiety in the market for real estate investments, and thereby the debt associated with them. A clear anticipation that values were going to fall, which they did. These interest rates are continually increasing upward. This was a function of Alan Greenspan's desire to slow the subprime market, where he increased the base federal funds rate by 25 basis points every quarter for beginning in 2004 through 2006. Some people, in the context of the blame game of the financial crisis, blame Greenspan for the very cause of the collapse by increasing these interest rates at the prime level. Up here you see just a snapshot that I took in 2018 of interest rates of different types of loans. So up here at the first column is the 30-year fixed rate, and you can see at that time it was ranging, from 4.1 to 4.27% over the course of this observation period. The 15-year fixed rate, slightly lower, of course, and the reason being because we have this maturity risk variation, right? So if I'm lending to you on a 30-year basis, I'm not getting my money for obviously for 30 years. The payments that you're going to be making are smaller, so your skin in the game, the amount of equity that you build up on this asset that you're paying off the loan on, is going to accumulate slower. The money is held in that instrument, the debt, for 15 years longer. And by virtue of that, the maturity risk, the 30-year rate, is higher than the 15-year rate. I'll slide over here real quick. This is what they referred to as the 30-year jumbo. A jumbo loan is loans that were made for houses of high value, or more honestly, mortgages of high value, to state it correctly. As of February 19, the jumbo limit was $484,850 in most markets. So in other words, if you requested a mortgage that's higher than that, or equal to that, your rate is going to be, as you can see, slightly higher. It's only incrementally higher though. So for example, it's 4/100ths, as you can see. 410 versus 414 as of 1/3/18. I also have this number up here just for reference, the 726,525. That's the jumbo limit in high markets, high cost markets, such as places like Hawaii and San Francisco and so forth, places of that nature where houses are really expensive, Los Angeles. So the jumbo rate is actually elevated for those markets to recognize or respect the reality that 484, for example, in San Jose won't even buy you a house. Last one is this third column that I'm working on. And that says 5/1 ARM. That's our first adjustable rate mortgage example. So note a couple things. It is lower than the 30-year fixed rate because the borrower is assuming the risk of interest rate changes. It's higher than the 15-year fixed. And the reason is because it will run for the full 30-year period, even though it's not indicated in the column. It says 5/1. And what that basically means is that for the first 5 years, this is the rate that the borrower will pay. 3.81, 377, etc. At the end of that 5-year period, the interest rate starts adjusting based on an index that I don't have in front of me to tell you which index they've used. But the max that it can adjust on an annual basis is this 1, the 1%. So each year, if let's say 5 years from now, interest rates are dramatically higher, on the 6th year, it will go up, in this example, from 3.81 to 4.81%. And in the following year, if they're still high, it could go up to 5.81%, depending on where the index is at. Again, it's fixed to only go up for 1% per year. Those indices vary. I told you that the one that you see primarily is LIBOR. Some entities, some lenders will use the federal funds type rates, or bond rates for U.S. Treasuries and U.S. bills at 6 months, 1 year, 3 year, and 5 years. And then there's the 11th District Cost of Fund Index, which is an index simply or traditionally used for the Arizona, California, and Nevada. Here's what those indices look like on a grid. And this grid runs from May '01 through the financial crisis, and then back into the recession and slow, steady recovery. This was a period of time, as I pointed out earlier, when Greenspan was raising rates and these indices were following suit. We see the collapse of the financial markets, and then we see the subsequent federal funds, or the Federal Reserve, doing its quantitative easing measures, thereby lowering interest rates precipitously to try to increase activity in the economy. And in essence, our rates have basically been in this world ever since. And these indices are what your adjustable rate mortgage would be tied to. So as an example, if for some reason you were to purchase an asset, a house or a commercial investment, in say '08, and you get to 2013 and it was a 5/1 loan like that one example that we saw, you would see that the indices have gone from 4% down to, in essence, 0.5% or 0, and you would see your interest rate charge on your mortgage actually decrease dramatically over the course of the following years. There are a number of different types. That 5/1 was it was partially restricted, as I indicated, in that it allows you only to have an increase of 1% per year. The same will be, by the way, for the downward flow. It'll only go down 1% per year. So we see typically This group right here represents the vast majority of options that you're typically going to see. The loan might be unrestricted, as it says. There's no limit on how much payments or interest rates can increase or decrease. That would be the kind of thing that you would have seen in the subprime world, where folks would get these interest rates known as teaser rates, where they would be 2, 3, 4% for 2 years, and at the end of 2 years, they would be tied to some sort of an index, and that may be 10 plus LIBOR, so it would go from 2, 3, 4% to 12, 13, 14, and 15%, literally overnight, dramatically increasing their cost of borrowing. There are ARM loans with interest rate caps, and those include both the annual, as I illustrated in that 5-1 example. It can go up 1% per year. There might also be lifetime caps, i.e. lifetime of the loan, and they're going to run somewhere around 6 or 7%. So the most that it can go up is a total of 600 basis points. So back to that one example that we had at 3.81%, the most it could be is 9.81% in that example. So they'll have annual caps, typically relatively small, 1.5%, and they'll have lifetime caps, typically moderate in the 5 to 10% range. You might also have an ARM loan that has a payment cap on it, and that payment cap does not involve the interest. And what that does is it renders the borrower the risk of becoming in a negative amortization position, because if they fail to recognize their payments that are not keeping up with their interest charges, then they're basically doing what we saw in our previous chapter, adding to the principal each month. This is similar to the kinds of things that folks experience when they have credit card loans and they pay only the minimum payment, and they have relatively high interest rates. They typically never pay into the principal. Additionally, another way that we can think about these is how the loan is adjustable. So in some instances, there's a portion of the loan that's fixed and a portion that is adjustable. And that's a rarity in this country, but they do occur sometimes in the commercial world, where the financial institution is willing to bear the risk for part of the project or part of the deal, but not all of it in terms of the interest rate. There's a hybrid ARM that starts off fixed and then becomes adjustable. That's that 5-1 example that I illustrated to you earlier. There's the loan that is adjustable at time 0, and then after a certain period of time, you have the option to shift to a fixed rate. So it allows you to play the market and take advantage of periods of time when interest rates fall. And then, of course, as it says there, you can adjust and option to choose whether to make the entire payment each month or just make interest payments only. In addition, there's also the option ARM, where the interest rate adjusts relatively frequently, sometimes monthly, sometimes quarterly. And in those option ARMs, what you, the borrower, are provided, which are the options to make regular payments, interest-only payments, some minimum payment, which typically results in a negative amortization period. And that minimum payment will typically change from year to year. You're allowed to do this sort of a float relationship with your loan, and then after 5 or 10 years, the minimum payment is recast, and then the loan then becomes more like an amortized fixed-rate loan that runs through the end of the term. So it gives you some flexibility in the early years, and then it locks you in later on. The last thing I wanted to point out in this set of slides is the interest rate that is actually charged. Where does that 4%, basically today's rate, come from? So it comes from the build-up approach that many of you that have had corporate finance or other similar classes are familiar with, where we're going to start with the risk-free rate. We're going to incorporate some expected inflation, and then that maturity risk premium that we saw earlier with the 15 and 30 variation. And that gives us our basis for what the overall interest rate would be. And then we're going to incorporate some other components into this, and most of them are going to be geared towards the timing in which this loan's made. So that's going to be the unexpected inflation, and then the changes in interest rates that are expected to occur over time. And then the relationship between the borrower's ability to pay and our anticipated receipt of that payment. And that's when we incorporate borrower and property-specific components into the risk of prepayment and the risk of default. If this is the first time you've viewed or thought about mortgages, prepayment risk is an important component, as we talked about briefly in Chapter 4. If I'm investing in this loan so that the financial institution can make more loans, I'm expecting or anticipating to receive those payments with the interest rate returns into the future. Into the future, basically as long as the loan was cast. Of course, as an investor, I'm also shrewd enough to know that buyers don't keep their properties for the full 30 years, typically. They don't carry their mortgage for the full 30 years anyway. But if your prepayment risk is really short, say 2, 3, 4 years after you purchase the property, then that really does become a huge concern from a transaction cost standpoint from an investor's perspective. So that prepayment risk is figured into what the interest rate charge would be. And then, of course, default risk. And if you cast back to the financial crisis, default risk was baked into an awful lot of those subprime loans that we've seen and heard many stories about. As I was talking about the teaser rate model a few minutes back, they would offer a teaser rate to get you to sign onto this property that you really couldn't afford, and that teaser rate lasted for a couple of years. Well, the lender knew the reality that in that market, houses were appreciating at 15 to 25% a year. So in the event that then in 2 years you could no longer afford that loan when the interest rates exploded, and they had to foreclose on your defaulted loan and sell the property, well, they would be able to sell it and not have any problems recouping the debt. That was the perceived model, and that was the reason why subprimes were not only popular with borrowers, they were also quite popular with lenders. Just like every other policy that's made out there for the public sector or the private sector, the intent, the notion, the idea behind some of those instruments that we saw during the financial crisis, the subprime loans and the low doc, no doc loans, all of those instruments were practically devised as ways of expanding the mortgage market. But of course, like anything else, as I said, they were exploited by the profit motive, and we made loans to folks that weren't capable of actually paying them back. Next thing you'll want to look at is I have a relatively short homework assignment for Chapter 5, and then we'll move into some special conditions on loans as we try to kind of wrap up this segment of our discussion on the debt side. Talk to you later.